I just have this slide.
Yeah.
Good afternoon, ladies and gentlemen. I hope that this Monday, the beginning of summer, finds everyone healthy and safe during this challenging time, and hopefully getting a little bit less challenging for many of us as New York reopens and many of us begin to return to our offices. We're very pleased at the Business Council of Westchester that we've been able to be the resource for Westchester businesses in terms of the most up-to-date information, guidance, and information about this COVID crisis as we started in March. And as part of that, we launched our Business Resource Center. And the Business Resource Center is a place to provide information, again, for businesses and education. And we're so pleased today that PCSB Bank, who is a very active and engaged and important member of the Business Council of Westchester and the Westchester and regional business economy, has been on top of and extremely responsible to the whole PPP loan process. And so it's my pleasure today to present a team that's going to moderate a discussion and provide great information on what is so important and has been asked by so many people about PPP loan forgiveness. So we want to remind everyone that the program is being recorded. It's also on Facebook Live and will be shared after this live conversation. And it's my pleasure to introduce the moderator and panelists, Joseph Roberto, the Chairman, President, and CEO of PCSB Bank, Michael Goldrick, the Executive Vice President and Chief Lending Officer for PCSB Bank, Dominic Petramale, the Senior Vice President, Retail Banking Officer, Director of Cash Management Services for PCSB Bank, Christopher Palmer, the Managing Partner of Cullen and Dykman, LLP, Thomas Bayless, Partner, Cullen and Dykman, LLP, and Ron DeSouza, Partner with PKF O'Connor Davies. And we want to encourage everyone to please submit questions and answers in the question and answer or in the chat box. We will be moderating them later on. And it's my pleasure now to turn this over to Joe Roberto, the Chairman and President and CEO of PCSB, to help moderate this very esteemed panel. Joe?
Thank you, Marcia. And thank you all for joining us this afternoon on such a timely topic. And really up to late last week, changes have been made to the forgiveness part of the PPP program by the SBA. So this presentation this afternoon will cover the changes that have been implemented to the program late last week, and it'll be presented by our panel. And I believe it'll be a good resource to follow when submitting your application to the SBA for forgiveness. Since we do have a lot of information to cover in about an hour's time, we'll try to get through the program so we can get to the question and answer period at the end. So why don't we go to slide 2, which is the agenda for today's program. So we have an agenda. It'll basically get you through the PPP application overview. We'll talk about the payroll costs that are included in the program. Talk about full-time equivalent employees. Talk about non-payroll costs like rent, mortgage, etc. We'll also discuss the documentation requirements, the key takeaways and recommended actions, and the tools and services that will be available to you in completing your forgiveness application. If we go to slides 3, what we've done is use color coding. The color coding will describe throughout the presentation certain changes that have been made to the PPP program since its inauguration at least a month and a half ago. So blue will be the rules that were in existence prior to the Flexibility Act. Green will signify the rules added or changed by or subsequent to the Flexibility Act. And red will address questions and ambiguities. So if there's nothing further to go on, we'll get into the program. And if we go to slide 4, it'll discuss the application process. I will now turn it over to Mike Goldrick, who will take you through that beginning of the application process. Mike?
Perfect. Thank you, Joe. And apologize for my technical difficulties. Joe and I are sharing a screen. But just on the application process, the key takeaways from screen 5 are definitely right up top. The application, the forgiveness application, importantly, was released Friday night, May 15th. And true to form, it was updated and reissued on June 17th, including the EZ version. All of this came about from the PPP Flexibility Act, which was enacted on June 5th. And true to form, they're following the motto of ready, shoot, aim. So there still remains many questions, as well as interpretations, and hopefully the rest of this presentation takes us through and clarifies on some of those open questions, as well as some of the most recent information and data. With that being said, some notable dates that we start to see on slide 6 and slide 7. As we remember, and it seems like an eternity ago for me, the PPP program approval started in April, in early April with round 1, and then took further shape in late April. So using those dates, assuming that your funding date was April 13th, the 8-week period would end on or about June 5th, and the 24-week period would end on or about September 25th. So just a huge time frame as far as the differential. The important part there too, as a sidebar, and just sticking with the June date, is that the application date for the PPP program ends June 30th, and many, if not most banks, are not taking any new applications. But those applications continue to trickle in through June, and with funding dates that are still going on. With that, we move on to slide number 7, which then talks about the time frame in which a forgiveness application is submitted and then reviewed by the bank or a third party reviewing that application by the bank and then submitted to the SBA. So from those dates that we saw on the earlier page, if the 8-week program is over, the covered period is over, and the application for forgiveness is submitted to the lender has 60 days to review that application and then submit it to the SBA. And the SBA, depending on timing, number of applications, volume, has 90 days to review and render their decision on that application. Getting into some more specific details about the application, I will now pass along the next couple slides to Ron DeSouza.
And before, if we could just go back to the last slide for 1 second. So just go back one more slide if you can. I just want to point out that the Flexibility Act came out and obviously extended the period to 24 weeks. Those people, those entities, organizations that got their loans before June 5th can choose the 8-week or the 24-week period. Those that got their loans after June 5th will be using the 24-week period. So there is a distinction as to what can be used. So I just want to make that clear. If we go on to slide 8, please. So the basic forgiveness calculation, let's just talk about that for 1 second. So so the basic forgiveness calculation is basically a bucket of eligible costs if you will, that you accumulate during your forgiveness period, or as we call it, the covered period. We'll be referring to it as the covered period. So you accumulate these costs in the covered period, and then you multiply them by an FTE reduction quotient. So basically, you're taking your bucket of cost and multiplying it by a ratio, and the closer that ratio gets to 1, you get full forgiveness. And we'll go into that as time goes on. But as you can see on this slide, you take your eligible costs incurred, and Joe mentioned that before. That is your payroll costs, your rent, your utilities, your mortgage interest. You take all that, you put it together in one lump. If you had any salary or wage reductions, which we'll talk about later, during the covered period, those have to be subtracted out of eligible costs. You then come up with adjusted eligible cost, and once again, you multiply it by that FTE reduction quotient, and you come up with a total forgiveness amount. Now, whatever that total forgiveness amount is, if you had taken a disaster loan, if you had taken an economic injury disaster loan, which many of our clients did, there's the first $10,000 of that loan is a grant. And the way that these programs sort of interface is your forgiveness on your PPP loan will be reduced by that $10,000 grant. That's the only really way that interfaces, and that gives you your final PPP forgiveness amount. Next slide, please. So what are the eligible amounts? So the eligible amounts are costs incurred and payments made for the following costs during the 24-week or 8-week forgiveness period. And the forgiveness period is the covered period or the alternative payroll covered period. That's very confusing. I get it. So now let's kind of try and break this down. Okay, so some borrowers will use an 8-week period. Other borrowers will use a 24-week period. Regardless of which period you use, you're going to look at your costs in the covered period. However, the instructions to the application also provide you with something called an alternative payroll covered period, which we will refer to going forward as an APCP. And the alternative payroll covered period is that if you have a payroll which is more frequent than semi-monthly, you have the ability to start your 8-week or your 24-week covered period on the first payroll period following the loan funding date. So there is an option. If that doesn't apply to you, it doesn't apply. As we started to say before, probably the third time we're saying, it includes payroll costs, payments on interest on mortgage indebtedness. Now notice that says interest on mortgage indebtedness. Interest, not principal. The goal of the program was to keep businesses running so you can pay your interest, but they're not looking to pay down your loan for you. And then also payments of rent and utilities. Both the mortgage and the rent and utilities had to be based on arrangements which were in place as of February 15, 2020. At least 60% of the amount that you're seeking forgiveness on must be expended on payroll costs. That was a change requirement that in the prior guidance that had been 75%. So when we went to 24 weeks, that was also lowered to from 75% to 60%. Next slide, please. Okay, so the application, the forgiveness application is separated into 3 parts. As we CPAs like to say, it's kind of like a tax return. So you have your PPP loan forgiveness calculation form. That's the form that sits on top. It's almost like your personal tax return sitting on top. And then that is supported by schedules. It's supported by a Schedule A and a Schedule A worksheet. So the way that this happens is the Schedule A worksheet is the worksheet that you fill out with all of your employee information. That then flows up to the Schedule A, and then the Schedule A then flows up to the loan forgiveness calculation form. The due date, Michael, do you want to talk about the due date for 1 second?
Sure. And getting back to the dates that we showed on the earlier slides, with that hypothetical, if you were funded in April 13th, the 8-week period would end around June 5th. And if you were on the 24-week program, it would end sometime in September. So from those dates, that period end, that's your covered period, you then have 10 months in order to submit your forgiveness application. Most, we imagine, would want to submit as soon as possible, but taking those dates out from June or September, out 10 months, really puts us well into 2021. On top of that, if it then takes the bank up to 60 days to review that forgiveness application, and it takes the SBA up to 90 days to review that, there's a long period of time that we could possibly be looking at these forgiveness applications coming in. We imagine that the sooner the better, but definitely have an appropriate time period to put together the information and the data in order to get that forgiveness looked at.
Next slide, please. So what we've got here is I've got an illustration of the loan forgiveness calculation form. You may not be able to read the left side that well. That's not vitally important. You're going to be given a copy of this slide presentation. And coincidentally, on the SBA website, you can easily pull up the forgiveness form and take a look at it. But what you can see is that this form is seeking information on payroll costs, which includes salaries, paid vacation, parental, family, medical, and sick leave, and then health insurance premiums paid by the employer, retirement premiums paid by the employer, also self-employment subject to limits, state unemployment insurance, and MTA. There's an MTA employer tax. So all the taxes are at the employer level. And I just know from the questions we've gotten on other webinars, just to clarify this a little bit, you use gross pay, right? So if somebody makes $100 a week, it's the $100 that goes down as payroll cost. People have asked, well, what about the employee withholding? Well, no, the employee withholding is in the $100 already. People have asked, what about employer FICA? No, it's not included. So it's only taxes that are paid by the employer at the employer level. It also includes non-payroll costs, as we discussed before, mortgage interest, rent, leases, and utilities. And you can see that off on the top left-hand corner. And then there's adjustments for FTE, full-time equivalents, and salary hourly wage reductions. That calculates down to a potential forgiveness amount, a forgiveness amount, and then also borrower certification. So there are some borrower certifications which need to be made at the end of the application process. Next slide, please. So there are certifications that have to be signed at the end. You have to say that the funds were used for eligible costs, that you included all applicable reductions in salaries and FTEs. You have to tell about them. You did not include non-payroll costs in excess of 40%. And for owners, the limit on the owner's compensation is limited if you're using an 8-week period to 8/52 of 2019 compensation, or 15,385, or if you're using the 8 weeks, the lesser of 2.5 months, 2.5 of 12 months of 2019 compensation of 20,833 for 24 weeks. Now, I'm listening to myself on that. It sounds kind of confusing. If you remember, when you first applied for your PPP loan, your application, you had to limit the compensation of any one individual when you applied for the PPP loan to $100,000. That cap has stayed in effect. So 8/52 of $100,000 is 15,385. 2.5 months or 24 weeks of $100,000 is the 2833. If you knowingly use the funds for unauthorized purposes, you may be subject to federal, civil, and/or criminal penalties. All required documentation is submitted with the application. The tax documents are authentic, and the SBA may request additional information, and failure to provide that information will result in denial of forgiveness. So Chris or Tom, I don't know if you want to comment on the certifications.
Tom, I'll just jump in on the certifications. Obviously, when you fill out the application, the authorized representative of the borrower is required to certify to about those 8 representations. One of the things that caused a lot of concern at the outset of the application process was this concept of necessity that luckily has gone away to some extent. When you fill out the application, you have to submit a host of documents that's required along with the application. If you recall, at the beginning of this process, there was a lot of bad press, a lot of bad publicity about larger companies that they felt may have access to other credit lines, really capital markets, as far as whether this loan was truly quote unquote necessary for them to operate their business. Many of you have probably seen that guidance has come out from the SBA in the form of FAQs and also, public statements made by Mnuchin that the fear factor is really reduced quite a bit. In the beginning, there was a lot of talk about the representative for the company making these certifications, that if they were wrong, especially in the subjective part of the certification, that there could potentially be monetary fines and criminal, pursuit from the government. But that luckily has gone away to a large extent, and the guidance we're getting there is a bit more comfortable for businesses. Tom, do you want to talk about the certification? I don't know if Tom's muted or not.
Sorry, there we go. Can you hear me now?
Yes.
Okay. So on the application, the first 7 of the certifications are objective, that it should not be an issue of subjective belief, which is what caused a lot of the confusion with the Mnuchin and the FAQs you were just talking about, Chris. Number 8 does have what I would call a subjective context to it, but that's for a safe harbor that we can get into later as time permits. But for the first 7, just make sure that all the numbers are correct, and you should not have a problem certifying that.
Okay, so I just did want to mention one thing that's come up in the last couple of weeks. So, there is still money left in this program. As Michael said, there are a lot of banks that are no longer taking applications, but what we have found in talking to different people is the people who really did not apply for applications were those people, did not apply for the loans, were those people that were sole practitioners or independent contractors. So a lot of them just did not know about the program. So just as a service to your friends and family, if you happen to be talking to anybody, there's only a week left, but if you happen to be talking to anybody who was in that situation, who files a Schedule C with their tax return, tell them that there are still monies available, and there can be places they can find to go. It would be a shame if those people go out of business only because they did not know about the program. So there are funds still available. Next slide, please. Okay, so this is what the Schedule A looks like. We said the Schedule A feeds up to the calculation form itself. The first part of it is for employees earning $100,000 or less. And that's, those employees are subject to salary wage reductions. You would have to put that number in if that existed. The second table is for employees earning greater than $100,000, and then owners pay is separate, summarized separately, and put on the Schedule A. So, and then it also summarizes all non-cash compensation, which is an odd name because it's basically health insurance, retirement plans, and employers' state and local taxes. It calls it non-cash compensation, but obviously the employer is spending cash to make those benefits available. So, but that's just the name they use. Next slide, please. The bottom of Schedule A, it sums up all payroll costs. So you come up to a total of payroll costs, which then goes to the main form. And it also calculates an FTE reduction quotient, which also flows to the main form. So if at the beginning of the pandemic you had 100 employees, how many employees do you want during your covered period? You want 100 or more, because if 100 over 100 is 1, and then all of your eligible costs are forgiven. So to the extent it falls below that, that's really when it impacts your forgiveness. There is a safe harbor available. We'll talk about that when we get a little further down. Next slide, please. The PPP Schedule A worksheet. This is a form which we'll go into later. It's not going to be filed with a return, but you have to put in every employee, and with an employee identifier, the identifier is going to be the last 4 digits of the Social Security number. We already talked about Table 1 and Table 2, and the instructions to the worksheet also contain guidance for computing your average FTEs, computing salary hourly wage reductions, and determining FTE reduction exceptions and safe harbors. So now the FTEs, the strange part is that when you put down Mary Jones as an employee, it's going to say, what is her FTE? Well, when you first look at the form, you think, oh, well, Mary's one person, I'm going to put down 1. Well, not so, because what you're doing is you're calculating her FTEs on a per pay period basis. So if one pay period she was a 0.5 and another pay period she's 1, then that all enters into the calculation. But once again, the instructions detail how to calculate it. Next slide, please. Okay, so this is table. This is on the Schedule A worksheet. This is Table 1. So this is for borrowers who receive compensation in 2019 an annualized rate of less than or equal to $100,000 for all pay periods. So you see, you put the employee identifier, which is the last 4 of the social, the cash compensation, the average FTEs, and if there was a salary wage reduction, you've got to put that in there as well. Next slide, please. This is for employees who received 2019 compensation at an annualized rate of $100,000 or more. Once again, you put in cash compensation, you put in their average FTEs, but note that you do not calculate salary and wage reductions for those employees over $100,000. Next slide, please. So determining payroll costs. This is one of the more complicated parts of what we do. From the outset of the program, we had much difficulty in determining whether the eligible costs were going to be determined on a cash or an accrual basis. Obviously, cash basis is when you pay it. Accrual basis is when something is earned or incurred. So in the instructions, it came out to say that it includes payroll costs paid and payroll costs incurred during the covered period, or the APCP. Okay, so payroll costs are considered to be paid on the day checks are distributed, or the ACH credit goes out. So my bankers on the phone know what ACH is. But basically, if you're making direct deposit, it's the day that the direct deposit transfers. Payroll costs are considered incurred on the day the employee pay is earned. Payroll costs incurred but not paid before the end of the covered period are eligible if paid on or before the next regular payroll date. So there's a possibility you can get part of a payroll towards the end of the period. But these rules are very important. These rules are very confusing, and we're gonna get into some of the confusion about that in a second. And that's kind of the red part on the bottom. What does this mean? So next slide, please. Okay, so the alternative payroll covered period. So borrowers with bi-weekly or more frequent pay periods may elect a 24-week or 8-week period starting with the first payroll after the loan funding date. Hopefully I said that correctly before. However, the APCP cannot be used for non-payroll costs. So it cannot be used for rent. It cannot be used for utilities. It cannot be used for mortgage interest. Salaries of owners' employees. We talked about this before. We talked about the limits. Either you have to limit it to 8 weeks or 2.5 months of 2019 compensation if they're over $100,000. And owner employees are now lumped with self-employed individuals and partners. So there is a line on the form for the compensation of owners' employees. However, owner employees are not defined. Once again, we said at the beginning of the presentation, if it's here in red is an area of conflict or lack of guidance. So I'll let Tom and Chris comment on this whole owner-employee little bit of a mess that we have on our hands.
Sure, Ron, thanks. So as Ron said, they added in the application, in the loan application, forgiveness application, this new concept of owner-employee. In the earlier, in the interim final rules and in other guidance they gave, and in the application process, there was the Schedule C filers and general partners. Okay, we understand what that is. They're defined terms. They're understood. They're in the tax law. But now all of a sudden, out of nowhere and without any explanation, they add this third column, this third group of owner employees. And the issue is, who are they? What are they? How are they going to be treated, et cetera? And there is the reason it's in red is there's a lot more questions than answers on this. Is an owner employee, is that someone who works for the company for an S corp? Is that someone? What about someone who works for a corporation or an LLC. However, they may have 1 or 2% of the company, kind of as a, you're a good long-term employee, I want you to be a part owner. Do they all of a sudden fall within this category? Or is it really for an issue of control that they're concerned about, such as with, general partners who control the company or obviously sole proprietorships? Other complicating factors, as in the headline, the outline talks about family members. Can you have a family member working for you? Are they attributed to, are they also lumped in with the person who controls it or not? We're hoping to get more guidance as we go along, but the concern is they added this, they don't find it, it's not defined in the IRS code. It's really not defined anywhere that I'm familiar with. And now they're either going to work up a solution or definition, or they're going to wait for the application to be going and say, to the lenders who are doing this, well, here's our guidance, you figure it out. I don't know which way it's going to go at this point.
Okay, and hence the title on our presentation, Ready, Shoot, Aim. It's a program which was rolled out, and then the guidance comes later. Next slide, please. So on payroll costs, many questions remain. Are payroll costs incurred prior to the current period, but paid during the current period permissible? This could actually result in 1 or more additional payrolls being included in payroll costs. And we'll talk about that with an example coming up. Are non-salary costs also considered to be paid when paychecks are distributed and incurred on the day the pay is earned? So are prior year retirement costs paid during the current period, the covered period included? And what about health benefits for the current covered period? I keep saying current, sorry. For the covered period paid prior to the covered period, or prepaid health benefits. So our advice is to pay expenses in the ordinary course of business and try and do business as usual. We do, as I often say to people, if you've got a $500,000 or $1 million loan, you don't want to be the CFO or the controller going to the board saying, you know what, I got 80% of it forgiven, but we still have $100,000 or $200,000 that we have to pay back. You don't want to be that person. So we don't see a lot of merit in being overly aggressive. You now have a 24-week period for most, well, for all, 24-week period for all, if you avail yourself of it to get forgiveness. So we don't really see a need to be aggressive. We see a need to be reasonable. So I don't know if any of my colleagues want to comment on this slide.
Ron, I would like to. Am I on mute or?
We can hear you.
Oh, great. Okay. So the screen says mute, but that's good. Yeah. On the what expenses and what variance are going to be looked at. We've spoke a little bit offline about this, and the way that the banks are most likely going to look at it is with a little bit of a variance factor. So the smaller the loan, the smaller the variance, probably less scrutiny. The larger the loan, the larger the variance, the more scrutiny. The banks are going to be looking at these directly themselves, as well as using third-party assistance. So it's basically following the adage that if it doesn't seem correct, it's probably not correct, or if it's a maybe, it should probably be a no. So the tighter that it gets, and also for the larger applications, the more detailed and more concise, the more likelihood is that, one, the banks aren't going to hesitate or have any questions, and number two, and most importantly, the SBA won't have any questions or hesitations. So our advice and guidance is to keep it as simple, as straightforward as possible. And when in doubt, I would leave it out.
Okay. Can we go to the next slide, please? So this, I see we're running a little short on time. So I'm going to just say that on this slide and the next slide, there are differing situations which present a scenario based on 8 weeks of forgiveness. And we use 8 weeks of forgiveness just to illustrate a point. But if you go through this slide and you compare this with the slide from 2 slides before, where we say that payroll has to be paid and incurred in order to be eligible for forgiveness, this scenario actually presents us an example of where if you're using an 8-week period, you could actually wind up with 86 days of payroll in your forgiveness period. So the question becomes, is this really what Congress intended? We don't know. We don't know the answer to that question yet. But clearly, if you take the rules verbatim, you can wind up with 86 days, and if you're using a 24-week period, you can wind up with even more. Next slide, please. Same thing with health insurance and pension. You know, obviously, many times health insurance is paid at the beginning of the month. So when it's actually incurred is different from when pay is incurred. But we believe, you know, that there are still remaining questions about health insurance and pension. One of the largest remaining questions is the last line on the bottom there, which basically says, you know, can you avail yourself of your 2019 pension contribution? Can you make that payment and it be an eligible cost? Now, we've had clients that have asked us questions going back to their 2015 payroll contribution. Can they pay off that liability? And quite frankly, there's nothing to prohibit it in the code, the regs, or the instructions. So you've got to be careful, but these questions still exist. Next slide, please. We talked about before, as we talked about this ratio, and the ratio is probably the most important piece of the forgiveness calculation, because you're taking all of your eligible costs and multiplying it by a ratio. To the extent that that ratio starts to drop, your forgiveness starts to drop way off. But for purposes of doing the forgiveness application, you need to determine your FTEs for 3 periods. You need to determine it for February 15th, 2019 to June 30th, 2019, for January 1st, 2020 to February 29th, 2020. And if you are a seasonal employer, any 12 consecutive weeks between May 1st, 2019 and September 15th, 2019. So in the ratio, these 3 bullets, that's your denominator, right? So you're going to compare your FTEs in your covered period against one of those base periods. So obviously it's in your interest to have the base period with the smallest number of FTEs. So therefore you have less of a hurdle, if you will, with your covered period. I actually gave this presentation to a bunch of schools. It was great that all the teachers understood what ratios and equations were. That was an easy day. The next bullet down, there is a safe harbor calculation for FTEs. And for purposes of that safe harbor calculation, you're also going to need to know your FTEs from February 15th, 2020 to April 26th, 2020. And if your FTEs fall off, for the safe harbor calculation, you're going to need to know the date at which your FTEs have been restored. And you have until December 31st, 2020 to restore FTEs that people have been furloughed or laid off. That date used to be June 30th, 2020. That's why we struck it out. So you've now got until December 31st, 2020. Now, many of you are probably use recognized payroll companies such as ADP, Paychex, Ceridian, and the like. We've heard, we actually have seen one calculation where they will provide you with these FTEs. So the use of computers can be very helpful in cutting all these periods. Next slide, please. So how is an FTE defined? An FTE is defined as, well, number one, it's based on hours paid as opposed to hours worked, but every FTE is calculated using a 40-hour week. So you take the average hours per week worked, average hours per week paid, divided by 40 and round to the nearest 10th. The maximum for each employee is 1 FTE. So if you have an employee who works a 50-hour work week, they're limited to 1 FTE. Once again, that's the complications of doing the calculation. What if your standard work week is less than 40 hours? If you have a 35-hour week or a 37.5-hour week, the answer is you have to use that calculation above. You still total the hours up and you divide by 40. There is an alternative simplified method available where you count any employee who worked 40 hours or more as 1 FTE and 0.5 for all other employees. So if you have an employee who worked 20 hours a week, they're a 0.5. If you have an employee who worked 5 hours a week, they're a 0.5. But what you have to keep in mind is you're doing this ratio, a numerator and a denominator, and you have to calculate both of them in a consistent method. You can't use the alternative simplified method for the denominator and the 40-hour method for the numerator. You have to do it consistently. Owners are not included in the average FTE computations. Don't ask why, they're just not. So that's just part of the law. And that could change, I covered the last bullet. Next slide, please. So the FTE reduction quotient, as we discussed before, which is on the bottom of the Schedule A, is the average FTEs in your covered period, or APCP, divided by average FTEs in your chosen reference period. That's what we talked about before. And we said before, you want the one with the lowest number of average FTEs. Next slide, please. So FTE reduction exceptions, if the borrower makes a good faith written offer to rehire a furloughed employee during the covered period, or APCP, which was rejected by the employer, and the offer was at the same rate of pay earned during the last pay periods prior to separation, and the offer is rejected, the borrower has to document that. And if you document that, it does not come out of your numerator, it does not come out of your denominator. So it has no effect on your FTE calculation. However, the last part of the third sub-bullet, if you make that offer to that employee who was furloughed or laid off, and they reject the offer, you've got to do what you've always had to do for an employee that was claiming unemployment. Within 30 days, you have to report them to the state unemployment insurance office, which is obviously going to threaten their unemployment insurance benefits. Like I said, that's never changed, but I know during the pandemic, we've got a lot of people whose employees stayed on unemployment because they were making more on unemployment than they were at their job. And also they didn't have to risk coming into the workplace and getting the risk of getting the virus. But this is a little bit of a fly in the ointment. You don't want it to impact your FTEs. Also, employees during the covered period who were fired for cause or who voluntarily resigned or reduced working hours, that will also not affect your FTE calculation, so you don't have to worry about that. And also in the new guidance, if you're unable to rehire or replace individuals who were employees on February 15th, 2020, and that's because of guidance of the Department of Homeland Security, the CDC, and I don't remember whether it covers state and local mandates, but Tom or Chris, you may want to comment on that.
Yeah, the guidance so far just mentions the CDC, the U.S. Department of Health and Human Services, and OSHA. It doesn't mention specifically the state, but it talks about the social distancing guidelines and mandates, et cetera. I would think that if the state, New York and New Jersey, obviously the prime example is Connecticut as well, follow those guidelines and incorporated essentially those, that should create a safe harbor for businesses that could not operate because of those guidelines, if they couldn't bring back the number of people because of those guidelines, I should say.
Right. So next slide, please. So we talked about an FTE reduction safe harbor, which is contained in page 8 of the instructions. You actually calculate your safe harbor in the instructions. So basically, you're exempt from a reduction in forgiveness based on reduction in FTEs if you reduced FTEs during the period you see, February 15th to April 26th, and the FTE levels were restored not later than December 31st, 2020 to the FTE employee levels in the pay period that included February 15th, 2020. There, in red, once again, there's no guidance on how long restored FTEs have to be maintained. Right now, this is just a point-in-time test as far as we read it. And employees hired to restore the FTEs do not have to be the same as the ones let go. It's called an FTE. It doesn't have a name on it. So an FTE is an FTE. Next slide, please. Okay. There is an area of salary wage reductions. So basically, if you've reduced salaries by more than 25% during the covered period or the APCP, as compared to Q1 of 2020, for employees who earned less than $100,000, this would apply to you. And if it applies, the amount of loan forgiveness is reduced by the amount by which the salary reductions exceed 25%, unless the annual salary or hourly rate is restored, used to be June 30th, 2020, by December 31st, 2020, to the level in place as of February 15th, 2020. We're not sure, once again, how long that has to be maintained. you're reading it just as we read it in the instructions. Next slide, please. Non-payroll costs. So non-payroll costs include mortgage interest, rent, and utilities. The agreement services must have been in place prior to 2/15/20. So it's not like you could sign up for a new lease and get that. They must be paid during the covered period. And so this is different than payroll. Payroll had to be paid and incurred. So this has to be paid during the covered period, or incurred during the covered period and paid on or before the next regular billing date, even if that is after the covered period. So that they give you one exception at the end of the covered period. Notice I did not say a PCP because the alternative covered period is not available for non-payroll costs. That is only for payroll costs. Mortgages and rents include real and personal property. Read it as you will. We don't really know what a mortgage on personal property is, although that is in the regs. Your friendly bankers might be able to explain that one. Prepayments of mortgage interest are explicitly disallowed. Do not prepay 3 months of mortgage interest. However, no such explicit prohibition against rent or utility prepayments exists in the code as it is now. Maybe that last bullet should have been in red. So you're probably starting to look at this, and you're probably starting to think, my gosh, there's so many undefined areas. Well, that's why we're going to give you some guidance in a while. There's no need to rush with your forgiveness application, be the first one in, and be the guinea pig. You can sit on the sidelines for a while. You have time to see if some of these rules and regulations are clarified or changed. Next slide, please. So instructions and current guidance on non-payroll costs, once again, do not prohibit payment of prior month's non-payroll costs or prohibit prepayment of future non-payroll costs. But does this mean the borrower can prepay several months of rent and utilities? And what about related party rent? What about the physician who has a practice of 10 doctors and one of the physicians owns the building and the rent is paid to his LLC? What about that? Well, it's undefined. And can you pay several months of deferred rent where you hadn't paid it already? Bottom bullet, borrowers can choose which non-payroll costs to include, exclude in the determination of forgivable costs. So as you have to be at least 60% over payroll, but if you're only 20% in non-payroll costs, you may throw some more in, or if you're at 50 or 60%, you may take some out. You can do that. You cannot do that with payroll costs. All payroll costs have to be included. The forgiveness application is much more complicated than the application for the loan. It's just the way it is. So with that, I think we're going to go on to slide 31, and I think Mike, you're gonna pick up on that.
Sure, absolutely. And as stated earlier, with the June 17th revision of the application, they also included a new easy form application. The good news about that application is that's 3 to 5 pages as opposed to 11 pages with instructions. So a very good adjustment and correction. That new easy application, as we see from the bullets, can be used by self-employed with no employees, or those businesses following the next 2 bullet points, with the key being that salaries or wages were not reduced by greater than 25%. A couple of the qualifications there being on basis of the number of employees and the average hours paid in that second bullet point, and in the third bullet point, definitely some qualifications if the business was unable to operate due to the COVID directives. The important part to the easy form is it eliminates the need to compute and submit the support forms for the FTEs, but that information does have to be maintained and kept. So although the forms don't have to be submitted, which saves some technical work, the data there to back it up should be there. That's a good segue into the next couple of slides, which identify a lot of the required documentation that has to be submitted with the application, most of which from a technical standpoint have been covered earlier in the program. So I'll run through relatively quickly the PPP loan forgiveness calculation form, the PPP Schedule A, the optional demographic information form, and then importantly, bullet point number 4, the information regarding the payroll, which includes the bank account statements and third-party payroll services, tax forms, the 941s and the state payroll taxes, and then receipts, canceled checks, and the additional documentation. Next slide. For the FTEs, the full-time equivalents, the documentation needs to show the average number of FTE employees on the payroll between February 15th and June 30th, 2019, or the average number of FTE employees on payroll between January 1st, 2020 and February 29th, 2020. If applicable, for the seasonal businesses, it has to include the seasonal employer calculation, and important to note, it must match the PPP Schedule A line number 11. Next slide. For the non-payroll costs, on the mortgage interest and amortization schedule, to include canceled checks, account statements for the covered period and 1 month after the covered period. For the lease payments, important to have a copy of the lease agreement, the canceled checks, and the account statements for the February 2020, the covered period, and 1 month after the covered period. For the utility payments, the copy of the invoices from February 2020 and those paid during the covered period, the canceled checks, and the account statements verifying those eligible payments. So big takeaway from there is, keeping those canceled checks and those account statements to verify those non-payroll costs. Next slide. Importantly is moving on to the documents that must be maintained. The documentation supporting the listing of each individual employee in the PPP Schedule A worksheet table, including the applicable documentation of salary and hourly wage reductions calculations. The documentation supporting each employee listed on the PPP schedule. On Table 2, received during any single pay period during 2019, and compensation at an annualized rate of more than $100,000. Bullet point 3, the documentation regarding any employee's job offers and refusals, firings for cause, voluntary resignations, and written requests by employee for reduction in work schedule. And bullet point number 4, the documentation supporting the PPP Schedule A worksheet, FTE Reduction Safe Harbor. Next slide. Very important on next slide is in bold, the files must be maintained for 6 years after the date of the loan is forgiven or repaid in full. And the information must be available to authorized representatives such as SBA officials, the Office of the Inspector General, and certain others that may be requesting copies of those files and the information. That being said, we move on to the planning and considerations, which I believe will be covered by Chris and Tom.
Okay. Chris, you want to start off?
Well, Tom, I was going to defer to you since at least for our personal PPP loan, you've done such a tremendous job with it. But I think one of the, and I know we're running late here, but I think one of the most important things when you're going through your covered period and you get to the end and you're ready to apply for forgiveness is that you really have to remember to document everything that you've done. We started out talking about the concept of necessity. And one thing that many of the business owners that we know are emphasizing and focusing on is that they're keeping detailed records of what they did, what the purpose of the loan was, why they had issues based on what's happened in the economy. And one thing that we've called it here at the firm is we want to create some sort of contemporaneous record as we went through the application process to show what we felt the harm was. One thing we call it, there's a concept in the law called legislative history. And typically when you're looking back at a law that's passed, you look at the exact language, the plain language of the law to interpret what it means. But perhaps there was a law passed a long time ago, let's say 1962, and you're trying to interpret what was meant by Congress when they passed this law. And maybe sometime people will look back to the CARES Act and say, what was meant by them? What we've tried to do is keep a legislative history, meaning a record of what we've done to make sure that when we do get audited, or any business, perhaps a loan over $2 million will get audited, and you have to presume that that's going to be likely. You want to keep a very detailed record of all your employment records, what your mental state was, what the business's mental state was when you took out the mortgage, when you took out the PPP loan. And you really need to do that, because when the SBA does come back and there are any questions, that concept of necessity that we talked about earlier, that's all going to play into it, and they are going to look for your record keeping at that point.
Yeah, no, thanks, and I know we're coming up at 1 o'clock. Let me just quickly on slide 38, maximizing forgiveness. As Chris said, the law. Anytime you look at a law, you look at the words. And as I'm a litigator, so I go and I say specifically they use an of there, they used an and there instead of an or. And that's all well and good. This law was passed so quickly. I've referred to it sometimes as a statute written on an Etch-a-Sketch. But that criticism is understandable, but it's also, you have to look at it in the context. The idea was to try to get the money to try to save jobs, et cetera. So if you look at your forgiveness application along those lines, did you use the proceeds to save jobs? Did you use the proceeds to save salary? Did you do what was intended by the law? You may fall short, you may not get 100% forgiveness, but if you did the right thing and you keep the records to show that you did the right thing, we believe that's the best way to maximize your opportunity to get forgiveness. Next slide, please.
Hey, Tom, thank God Etch-a-Sketch hasn't gone out of style.
Exactly. And again, is it okay to pay bonuses? Yes. Would I say pay bonuses to the high-end individuals and not pay anything? I mean, look, use a rule of reason here. If the auditors come in, and if you have a loan above $2 million, you will be audited. If you have a loan below $2 million, you may be audited. Okay, and the higher it is at $2 million, it probably increases on a sliding scale. So keep that, and keep the good records. If you don't have the good records, well, if you don't have contemporaneous, don't say, oh, well, I missed the boat. No, go back and do as much as you can. Make sure you have the records. And, you're not going to post-date things. You're not going to predate things. You're going to keep in contemporaneous from now on. And if you do it the right way, and if you do it the way that's in keeping with the spirit of the law, hopefully, when the lenders and then the SBA look at it, you will get forgiveness. That's all. I'm sorry, just paragraph 40, the 28 weeks or 80 weeks, technical, not really that technical. Some people, when the Flexibility Act was passed, were wondering, does that mean I have to choose between 8 and 24, or can I choose something like 12 or 16? The answer, as I read it, I think most of the guidance we've seen, no. It's either you choose 8 weeks if it was before the June 5th date that the loan is made, or if it's after that, you can choose 8 weeks or 24 weeks to do it. Most people will probably choose the 24 weeks. There are reasons to choose the 8 weeks that are highlighted here, and obviously consult with your attorney and your accountant to make the decision as to what's right for you. And what we said all along, the only thing that we could guarantee is more change. SBA guidance is coming out every day. On Friday, I believe it was, they came out. It wasn't the SBA, I believe it was actually the Mnuchin and the Treasury Department, that there will be public information made as to the people who receive the loans. I believe it's a cutoff of 150,000, and then there's some differences based upon the levels as to the level of detail of the information that will be provided. But apparently, unless things change, the information as to who received the loans, in what amount, and some other information will be made public. So that's something to keep in mind, and another good reason to keep a a good record of all your information. You're going to need it for the lender. You're going to need it for the SBA, whether they lend it or not, and you're going to need it for next year's, next year's or the year after's taxes when they come due to show what happened to the proceeds and et cetera, et cetera. So, next slide, please. Those are more changes on the way, which I just spoke about. And finally, a disclaimer. We always say, we're not, and this is very important. Obviously, Chris and I are attorneys, but we're not here giving, this is not an attorney-client relationship here, but we're trying to give general information. Ron is acting, obviously he's giving great information as an accountant that doesn't create that relationship with them. But, and those are the standard disclaimers, and the lender relationship with the bank, et cetera. But the disclaimer that I would say is, everything that you heard today, follow up on. If you have questions, please, you have our contact information, contact your own professionals. And if you have the ability to go online and read it and follow it yourselves, please, as Cy Sims used to say, an educated consumer is our best customer. Well, an educated borrower is our best client. And I really request that please keep on top of this as much as you can, and keep, if you have any questions, contact us or your professional. Thank you.
Okay. Can you unmute me?
You're good, Joe.
I'm good. Thank you. I'm sorry. Well, thank you, Chris. Thank you, Tom. And on slide 43, what we have for your purposes of information is contact information for the panel, including myself, Mike Goldrick, and Dominic Petramel from PCSB Bank. Any questions, obviously you can call any one of us. And then support is also available from PKF O'Connor and Davies. And Ron DeSoya is available if you need some guidance through the application process. And of course, any of the legal advice that you may need from Chris and Tom from Cullen Dyckman. I'd like to thank the panel for their input and for their timely information, which is important for those businesses that are scheduled to complete their application. I know that we've run a little bit longer than we should have, and I know that we will follow up with questions and answers. I know we've kept track of the questions that have been submitted to us. And I think, Marcia, you think we'll follow up at a later date on that?
Absolutely. So, Joe, I appreciate your being observant of the time. We'd like to keep that. I know that there was one question in the chat room. I don't know if that can, in the question and answer, I don't know if that could be answered quickly.
Yeah, I could, Marcia, I could take that. Yeah. So we were able to answer most of the questions. We typed the answers as the presentations were going on.
Wonderful.
So, but the one that we've got remaining, which I was not able to answer through the system, is our staff works 9 to 5 with an hour for lunch. We have always said they work a 35-hour week. How does this impact the full-time hours for PPP? Well, essentially, if it doesn't really impact you if you maintained your employment and you calculate both the numerator and denominator at a 35-hour week, it's not going to impact you. If you had to change FTEs, the law says it's for the hours, not the hours worked. So it depends whether you define that lunch hour as being paid or not. So I think that's the answer. But any further questions, we're happy to answer. I just wanted to add on to one thing Tom added at the end. We've done this presentation probably 15 times or so. And the one thing which we do, which is an advertisement for the attorneys on the call, is this is a really changing environment. Every time we put this presentation together and taught it many times, 20% of it changes the next day. So it's been entirely frustrating. We've been very mindful to get changes out to people, and if something changes dramatically here, I'm sure through the Business Council we could get something out in terms of an article or something to let you know what's happening. But you have to consult with your attorneys. These are laws. These are laws, and we as accountants, we do presentations on it. We read laws all the time, but we don't read them as well as the attorneys do. And if you're going to take a position which you consider to be aggressive, the best thing that you can have in your file is documentation that you consulted with an attorney. And that I think goes a long way with the SBA. We also in terms of doing this, it's very difficult to do this without some sort of an app, right? Some sort of an application. We do have spreadsheets available. If anybody wants to contact me, we can put that out to help you with that. So, but there's no reason to rush to file these applications. No reason to rush at all. Wait and see how these things change, especially the prepayments on or payments of old medical and pension and things like that. So,
thank you, Ron, and thank you for the work that PKF O'Connor Davies always does. Thank you to Cullen and Dykeman. And special thanks to PCSB Bank and Joe Roberto, Mike Goldrich, Dominic Pachamala, and the team that really has worked very hard to be very responsive, especially to the small business community in Westchester and the Hudson Valley. So I do invite anyone that has questions after we end in a minute. Please feel free to contact me at the Business Council. I'm happy to submit those questions to the team as I receive them. So with that, we thank you. Also want to mention one thing. We are having a political leadership series tomorrow, and we're very pleased to have Pat Foy, who is the head of the MTA, and Catherine Rinaldi, who's the head of Metro North, be joining us. That's at 11 o'clock tomorrow morning, and we have information on our website. Many employees have spoken to us about commuting. Many employers have employees that reverse commute into New York, and it's a very, very timely and important topic as New York reopens. So with that said, PCSB, thank you again. This will be on our Business Resource Center. We hope everyone stays safe and stays healthy. Have a great day.
Thank you.
Thank you.